You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYFI.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I am your guest host, Don Davis, filling in for the vacationing Caroline Weaver. And I'm here today with Lars Jensen. Lars, how are you and where are you?
Excellent as always, and as almost usual in a new location. As you might see, I'm in a very old car. It's a 38-year-old camper. It's a test trip. Just crossed the border from Denmark down to Germany. Let's see how she does.
That's great. I do love that you're resilient and you're always in different places. You know, I'm here in boring old Virginia Beach where it's quite hot. But, it started summer this week. It's going to be about 100 degrees, so hopefully nobody melts in that process. But anyway, so what's the latest? What's on top of mind when you think about what's been going on the past week?
Yeah, I think that there are two things. One is what I could only describe as a virtual collapse of the high rates on the Pacific, and then, of course, the debacle in the Middle East. And let's jump into the Pacific. I hesitate a little bit to use the word collapse about freight rates, because from my perspective, collapse would kind of signal that rates are dropping to loss-making levels. That is absolutely not the case. Let's be clear on that. But if we look at some of the spot indices, some might have noticed, especially the SCFI, that came out on Friday. In just 2 weeks, it undid all of the increases that we saw ever since the China tariff pause. If I look back over the what is now 16-year track record of data from the SCFI, this is by far, not even close to, but by far, the sharpest 2-week contraction we have ever seen in the rates that were quoted on the SCFI. The other spot rate indices seems to follow suit. Now, why would that be? Usually the reason is simple, supply and demand. And we know the supply side. We've talked about that for weeks here on the podcast as well, that the carriers took quite a while to inject new capacity. That capacity has now come on stream over the last couple of weeks. So is it too much capacity? Well, here's the fun part. Well, not so fun, especially if you're a carrier. But when the tariff pause happened, it immediately led to a surge in demand. As we have also talked about, the initial surge was due to cargo that was already waiting in boxes to be shipped. That surge definitely did happen. It was real. Now, here's the challenge. It took time for carriers to move capacity in, and the assumption also when I spoke to shippers early on was, of course, there would be a massive amount of front loading of cargo. So the expectation was that demand surge would also continue. Well, that was before issues like the court ruling saying that tariffs were unlawful. Then that was appealed. We have all these uncertainties that were further interjected. And as we also talked about last week, it has left a lot of the U.S. importers somewhat in a conundrum. It's very, very difficult to see what is the right way forward. Should we hold back cargo? Should we front load? Well, even the ones that were expecting a lot of front loading 2 or 3 weeks ago suddenly pulled back. They well, hang on a second, maybe front loading is also risky. So that means a sharp contraction in demand at exactly the same time as all the capacity was brought on stream. That, I think, is what is really driving the downturn. Now, the problem here when we're analyzing supply and demand versus freight rates, we only have some of the puzzle pieces from a data perspective. We know for a fact that capacity has been increased. That is measured pretty accurately. Getting demand side data is always lagged by not only weeks but months. So getting solid data is virtually impossible. Can you get anecdotal data from individual carriers? I'm going to ask you in a second, for example, Don. Sure you can, but that does not constitute solid hardcore data. But this is where it becomes interesting because we do have a new way of also trying to gauge the solidity of the market. Now, bear with me here a second. All the usual spot rate indices, I think everybody, myself including, have been following for years, basically based on quotes. But if you think it through, the way this market works, if you suddenly see a massive reduction in the supply and demand balance, that means the quotes might be completely genuine when they are made. They may suddenly not lead to a lot of bookings. And even if they do, if the market goes down rapidly, as everybody in the market knows, if I made a spot booking at a high rate and suddenly I can get it $1,000 cheaper, most shippers would renege on that first booking and go to the second cheaper offer. So even if it leads to bookings, the cargo doesn't necessarily get reloaded. This is where it becomes interesting. You should be able to see a graph here. What I'm showing you here are the difference between the NYFI and the WCI forecast. Now, mind you, it's not a forecast. the jury that makes WCI. It's not their forecast. What I mean by this is if I take the WCI spot, that is usually indicative of what actually gets paid for cargo moving a couple of weeks later. Again, the time lag between quotes to cargo getting loaded. You can see how this fluctuates over time. What I would really point to here is the index point just from Friday last week. That's at the very end. You can see this virtual collapse. We've had here for at least the last 4 or 5 months, whatever price indication came from the quotes, what actually got paid from spot rate cargo was somewhere between $0 and $500 lower. That's fine. That's a stable benchmark. This now dropped to more than $1,500 below. It's a more than $1,000 per FFE drop in a single week. What this tells us is that the quotes that were made a couple of weeks ago, very little cargo ended up in reality moving at those rates. As I said, they might have been booked 2 weeks ago at those high rates, but even if they were booked, they most certainly did not appear as physical cargo on board the vessels themselves. This is the full 2-year time span we have seen of the NYFI versus the WCI, and this is the absolute sharpest week-on-week contraction that we have ever seen. So let me just unshare and get back to you there, Don. To me, this is a very, very clear indication of a sudden and rapid shift in the supply and demand balance. A balance that warranted extremely high quotes 2 weeks ago because there clearly was the interest from the shippers and the carriers hadn't quite brought the capacity in, to a situation now just 2 weeks later where the capacity has indeed been brought in, but the shippers to a large degree have changed their mind when it comes to front-loading cargo. Even though we don't have demand data, what I think, especially the NYFI versus, in this case, the WCI, you can do the same thing versus USDFI, for example. It actually illustrates with data just how rapidly the sentiment in the market has changed. We're talking just within a couple of weeks, and it's a change where I don't think we have seen anything as drastic, I would say, at least since the financial crisis. So that's what the data is telling me. From a more practical, hands-on perspective, what are you seeing in the market, Don?
Yeah, that's interesting insight. And let me just start off by issuing a disclaimer because Zim as a carrier operates on the U.S. West Coast, but we have a priority product we operate, so it's more like Matson, EXX. It's relevant because there is a markup over the current market rate, and then there's premium if you want expedited or fast service. And then we operate a P&W service. But we do have some perspective on what's happening there. And I think you're absolutely right. I mean, I think what we saw is carriers deployed quite a bit of capacity on the U.S. West Coast. And what you saw is that initially there was quite a bit of strength. But one thing that we observed is that there was quite a bit of fall down. So customers were booking and not showing up, which really doesn't normally happen in the import trade, particularly when it's strong. But I think that's an indication that customers were booking, they're seeing rates fall, and either one of two things happened. Either they were shopping and saying, oh, okay, I can save $1,000 by going somewhere else, or they were saying, you know what, maybe I don't want to front load. Maybe I want to wait and see how the rate evolves because I can see this downward trend. Maybe it doesn't make sense for me to ship now. So from our perspective, we're just seeing the pattern that things are showing up and not necessarily loading. I also want to say that, we primarily operate in the U.S. East Coast. We operate a service with MSC. And I think there it's a bit of a different story. It's a lot more stable. You don't see the same kind of rate volatility. But that makes sense because that's not where the capacity was deployed. The capacity was deployed on the U.S. West Coast. So it'll be interesting to see once things normalize because I think what this means is that some of that capacity was deployed probably won't remain there given that the rates have eroded in a certain way. Again, your point is that they're not loss making, but they're not as lucrative as they might have been either. So you might have other purposes for those ships. So it'll be nice. I mean, we haven't had stability for a while. Feels like it might have been a long time ago since we had that, but it'd be great to see in a steady state, what do the rates look like and how do the rates evolve?
Yeah, well, you can say steady state does not appear to be what is on the cards if we broaden our perspective out from the Pacific. I want to add some words on also what I think is top of mind here coming into Monday morning is the escalation in the Israel-Iran war, where I think everybody by now is aware that the U.S., it will probably be wrong to say that they joined the war, but they definitely went in and dabbled in it here on Sunday as well by directing an attack directly on the Iranian nuclear facilities. What we are still uncertain of is what would be the practical ramification of this. I don't want to launch into a major geopolitical issue here. I want to look at it from a shipping perspective. If we look at it specifically from a shipping perspective, the key is the Strait of Hormuz and subsidiary also the Southern Red Sea. In the Strait of Hormuz, at least when we are taping this podcast, there is no change. Operationally, there is no change. Nobody has been attacked in the Strait of Hormuz. That's a fact, as of at least when we're taping this. We also saw yesterday how there were at least voices in the Iranian parliament calling for a closure of the Strait of Hormuz. Again, let's be clear, that has not resulted at this point into any tangible action at all. Also, the Iranian parliament doesn't really decide anything. That goes to the Supreme Council anyhow, so it's more of a recommendation. Should also still be clear, I think I mentioned it a week ago, the notion that somebody closes the Strait of Hormuz, that's not going to happen. That would be virtually impossible. What we would see was a heightened risk profile, like in the Southern Red Sea, that would cause some shipping lines to say it's not worth the risk and therefore not go through the straits. We're not seeing that with any of the container lines yet here as of Monday morning. Both CMA, CGM, and Hapag-Lloyd have issued statements saying that for now they're operating completely normal through the Strait of Hormuz. There is no, of course, we need to monitor the situation. I think it will be a very solid prediction that within the next few days we will see some sort of retaliatory action from Iran against U.S. interests in the region. We just haven't got any clue what shape that might take, whether that involves shipping in Strait of Hormuz or not. We certainly don't know. We look over on the Red Sea, of course, that has been partially closed for a year and a half. The Houthis completely, as expected, went out in strong support of Iran. And I would also say from the messages we got from the Houthis, the ceasefire they made with the Americans only about a month ago, saying that the Houthis would now, in quotation marks, only shoot at Israeli ships, now extends back to U.S. ships as well. Joint Military Information Command also said that in this context, U.S. shipping should include U.S.-operated ships, U.S.-flagged ships, potentially also U.S.-owned ships or U.S. ships with U.S. cargo interests. So the risk has risen. But I think a lot of those ships that will be in the target profile, and certainly on the container side, they are already avoiding the Red Sea. So at least for now, no tangible change, but certainly an increase in the risk profile. If we then turn to one of the things where it has had at least a little bit of tangible effect, that's actually not in the Strait of Hormuz. That relates to the Port of Haifa. And the Port of Haifa is not destroyed. It operates perfectly fine. There's not an issue there. But we did see Maersk over the weekend cancel the services into Haifa on vessels that Maersk themselves operate. That does not mean that Maersk has ceased acceptance of all cargo coming into Israel, just that they won't operate their own ships into the Port of Haifa. As far as I'm aware, Maersk is the only carrier for now. Now, given especially you, Don, sitting with Zim, how do you see especially the situation in servicing Israel and the Port of Haifa?
Yeah, I mean, for us, we continue to operate as normal. The expectation is we will operate as long as it's safe and there's no danger to crews and our cargo. But for us, we see that we'll continue to participate in the Port of Haifa and having deliveries to the Port of Haifa. And just to amplify the point of where Zim sits, we just launched a new service calling the Port of Haifa. This is a combination of air freight because the airports have been closed and there isn't a way to get air freighted cargo to Haifa. So what we've done is we've partnered with our logistics arm. We're running planes from the U.S. into Piraeus. And then we're operating a feeder service, which we are doing a partnership with Jazz Forwarding to consolidate the containers and get them into the Port of Haifa. So we're innovating and finding solutions, but I think when you see us, we're adding services to Haifa. We're not going backwards. I think that's an indication of our mindset of where we're at. And we see it at, again, we'll continue to participate as long as it's safe and the port's available and not impacted. And I think you can count on Zim being the last carrier to withdraw from Haifa, even though there's no sense of that around here. But again, things change pretty quickly.
No, and I think that might be a good segue to also where we are ending the podcast this way around, that there is no good way of getting certainty. There's no good way of predicting what happens. And this is where we come full circle to where we started. with this rapid reduction in spot rates on the Pacific. The way I see it is, let me phrase it maybe slightly controversially. I don't see anybody did anything wrong. I actually think everybody was acting very prudently and everyone had likely the right forecasts, but conditions simply changed too rapidly. The consensus, and that's not just amongst the carriers and forwarders, but also the shippers, the moment we got the pause in the China tariffs, this would inexorably lead to a surge of cargo. From cargo that was standing, that absolutely did happen, and also from front loading. Also, basically, all shippers saw it that way at that point in time. The carriers cannot magically teleport ships into the right ports, so that took a few weeks to bring the capacity to bear. Unfortunately, by the time the capacity then arrived, conditions in the trade war had then changed to the point where shippers that were gung-ho on front loading suddenly changed their mind. So even though the capacity was put in there, because the shippers indicating a desire to move cargo, that desire then disappeared rapidly. That also shows that at least the ocean-borne supply chain, it cannot change from hour to hour or from day to day. When you're setting something in motion, it takes weeks to unfold. And apart from maybe the financial crisis more than 15 years ago, usually macroeconomic developments don't change and unfold as rapidly as what we have seen in the US over the last few months. So if I was to predict anything, I might predict that we are going to see more of these rapid swings where we suddenly get supply and demand massively out of balance simply because we cannot change physically fast enough to match how quickly regulations change.
Yeah, I think you're right. I mean, I think that, post-COVID, you start to see during COVID, actually, you start to see all this rate volatility. And it's not the rate kind of volatility that you saw in the years prior. If you saw a $500 rate increase, people were shocked and sort of balking at that. Now the rate changes by thousands of dollars within weeks. And it's, not great for the carriers because that kind of volatility, you're trying to manage the network, you're trying to manage where there's demand. And I think for shippers too, it's certainly, I can't imagine how fun it is for shippers to explain to their CFO why they're so far off their freight budget. And it's because, you have this rate volatility. So it's a difficult situation. And I think I think you're right. I think it's here to stay because again, these things are changing pretty quickly. And, as they change, the price is certainly going to change with that. So when you start to think about the week ahead, what should people, is there anything that's top of mind that people should be on the lookout for? Is there anything with the trade war or what do you see when you think about the upcoming week?
Yeah, I think I'll watch out for two things, at least in the upcoming week. One, obviously, is the unfolding of the Iran-Israel war and how that then extends to the Iranian retaliation against U.S. interests in the region, because that's going to be extremely important in terms of how this unfolds going forward, not only whether it draws the U.S. further into the war, but also whether a retaliatory action would be against what you might call legitimate military targets, say U.S. bases, or whether this is taken more towards, for example, interfering with commercial shipping interests, which are two very different approaches Iran could choose to take. If it's the commercial impact, not only should we be worried about major container vessels suddenly doing U-turns, not going in, but the obvious concern here would be the impact on oil prices if this is to happen. The situation over the last 24 hours in itself has caused oil prices to start increasing again. The other thing I would start to look for is it's only a couple of weeks down the line when the pause on all of the reciprocal tariffs end for every country except for China. So all of these tariff pauses will end on July 9th. And actually, given that July 9th, for the cargo to actually clear U.S. customs, we're coming up to the very, very end. If I was to lean out and make any kind of guess, I would not be overly surprised if there is another extension of the pause. Because for some period of time, I would find it extremely unlikely that the U.S. would suddenly have trade deals with about 150 countries around the world between now and July 9. But I also don't necessarily see it as likely that the U.S. would suddenly re-implement everything and go through the turmoil that we had when they were working out.
Yeah, I think you're right. A lot of people are wondering and asking us about what are we hearing in the trade war, and it's been very quiet ever since the president announced on Truth Social there was a deal with China, and it was short on details, and then it's been sort of quiet. Now, again, the first point, there's this other thing that's distracting the administration right now for sure. But what are the implications? I think everyone's sort of waiting to see. It would be great if there's an extension or something that's a little bit more long term, but again, we all wait to see what's going to happen. And it's an environment where every day you have to check the news because it seems like something's happening somewhere in the world. It's a new environment. But okay, Lars, is there anything else you want to cover in the show today?
No, I think we covered everything that at least is most pertinent to know here as we are getting into a new trading week.
Yeah, definitely. I mean, there's certainly no shortage of things happening, but hopefully everyone liked the show. And thanks for listening, everybody. And don't forget, rate us, review us wherever you find our podcast. And Caroline will be back next week, back from her vacation, and maybe she'll share some pictures. I saw some; they're pretty fantastic. But anyway, she'll be refreshed, energetic, and she'll be there, and I'll be back doing my normal thing. But thanks for listening, everybody, and have a great day.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.